Hello and welcome to Hardman Talks. I'm Larissa Adams and I'm here with Hardman Co's property analyst, Mike Foster. Mike, hi, it's great to have you here.
Hi, Larissa. Nice to be here.
Great. So Mike has over 30 years experience covering a wide range of corporates in the property sector, and that's throughout his time on both the buy side as a fund manager and as a sell side analyst too. So today we're going to have an update from Mike on where REITs are positioned closing out the year. We'll have a look at how they performed this year and how investors can interpret their valuations in relation to NAVs versus share price indicators, and assessing their performance in comparison to historic levels. So I think let's get straight into it. I think what would be helpful, Mike, is if you tell us in 30 seconds or more what a REIT is and give us a little background first.
Sure, yeah. So real estate is obviously an investment that predates equity markets, been around for thousands of years, but the main way for investors to participate is through REITs. These are real estate investment trusts. They came into being in the USA in the early 60s, and the legislation came to the UK in 2006, when 9 UK property companies converted to REIT status, including 5 in the FTSE 100. Their tax status encouraged the overwhelming majority of property companies to become REITs since then. The REIT pays no tax in any meaningful way. The investor, if she is liable for income tax or capital gains tax, they'll pay that, but the REIT as a vehicle doesn't. And today, over 70% of REITs are still US based. So if we look at a chart of the past performance of the REITs index, it shows that as we are now approaching the year end, it's up a couple of percent, pretty much flat on the year. And the picture in 2023 is that early on, the index rose 12%, but by the autumn, it was down 8% since the start of that year. But the point about 2023 is that, it's been a pretty depressed year. It started 24% down on the all-time high, which was as recent as New Year's Day 2022, before all the terrible events in Russia and further interest rate concerns. So looking at it a bit on a longer term view, the index is now about 5% below the average for 2019, and we're about 5% up in the past 10 years. So 10 years ago, we were only beginning to recover from the financial crisis. So really, that's sort of pretty modest returns on that kind of decade-long view. So with the index down 22% from its post-pandemic high, is this a buy signal, given that it's trading at not much up where it was after the financial crisis? I'm afraid our conclusion is that while it is in cheap territory, it's only about 5% below trend. So on the face of it, this offers perhaps some special situation opportunities, but not a major seminal low point. That's what we conclude. And worse, the past 30 years have seen interest rates falling. So for it to be around 5% below trend currently, it's not as exciting, sadly, as it might appear. And unfortunately, it gets worse. The 5% below trend refers to what we show on this chart coming up, which is a very long-term chart of the index versus the NAV. And I'll explain that in a second. So the chart shows it again being somewhat cheap, somewhat below the average for the past 30 years, but there is a major sting in the tail.
Okay, well, what do we mean by cheap exactly, and how do we get it to being 5% below trend? What's the sting as well?
Yeah, so NAV, I'm sure listeners will know net asset value. So the REIT itself will have a net asset value. If you add up all the value of the assets and take away the liabilities like the debt, that'll mean that you can have a specific number pence per share for the NAV. And what we're doing is we're looking at the share price to that NAV, and is that relationship looking cheaper than it has been over the past long term, or about right, or more expensive? So if we look at this past 30-year chart, we see how far it's traded above or below the NAV. And we've got a series which shows an average level of about a 7% discount to NAV, in extremes of 25% in 2009, with a peak of a 15% premium in 2000. And that late 2000 premium is a bit of a quirk from the formation of some technology-based REITs. Of course, it spikes down in 2008 and again in 2020 because of the financial crisis and COVID. In more recent memory, the large majority of the time, the REIT index traded a discount of between 7% and 0%. So with the index currently trading at 11% discount to NAV, that does seem cheaper than the average for 2014 to 2021, which was about 7%. So the long-term average is also about 7%, but we'd rather look at the longer term. So what does it mean in terms of the ratio of NAVs and share price at the moment? Well, one of the reasons why we think that it's not particularly cheaply valued, although it is a little bit below the average, is that NAVs have generally risen over time. So the NAV is generally looking at a historic number in the report and accounts of the companies that are in this REIT. And it's usually a bit understated because by the time you come to now, time's moved on, and on average, asset prices have gone up. So REIT share prices reflect the current market, and their NAV reflects the history, the time when the NAV usually was a little bit lower. So currently, however, NAVs are falling. The market's pretty bad. So, for example, take British Land. It reported last on the 13th of November this year, and its NAV at 565p was down 19% year on year. So that, I think, indicates to us that, okay, it's been updated, but it takes time for all the NAVs to be updated, and the NAVs are still falling somewhat, a bit less than that 19% level, but there is still some fall to come. So if the NAVs were currently up to date, they would be lower than what the reported historic numbers are. So really that erodes the NAV number, and it means that if you're looking at that snapshot where the NAV is currently at around about an 11% discount to the share price is about 11% discount to the NAV. The real NAV being a bit lower, it means that the share price discount is a bit less. And given that I was saying that the average for the past 30 years is about a 7% share price discount to NAV, then really adjusting for where the NAV should be stated, we're really about right. So that means that, for the purists, we are probably about right. But if we dig a little bit deeper for the purists into what the indices have within them, then one of the shares, the biggest share, is a US REIT called Prologis. And that's not far short of 10% of the whole index. And remember, about 70% of the world REIT index is based in the US. Now, this Prologis share, which is about 10% of the index, is trading at twice NAV. It's got good prospects, and I'm not making any recommendations on Prologis, but I'm just saying that if you were to strip that out, it would make the index as a whole have a share price that is kind of, raised by that Prologis thing. If you strip it out, the share price would be a bit lower, and it means that you've got even less of a discount relative to the share prices, stripping out that Prologis, which is on a big premium. So again, this isn't really telling us that we're on a screaming buy and certainly not a screaming sell, because it is trading at a discount to NAV. So there is, some value in there.
Not as much.
Making that adjustment, it does look as if it's about right to, frankly, a little bit expensive.
Yeah, it makes sense, Mike. And thanks for contextualizing that for us. Helpful. Okay, well, broad market indices are near all-time highs, but REITs are down over 20% from their all-time highs. So how does that look versus what's happened in the past?
Well, let's look at those REITs share prices rises and falls versus equities. Looking at the 2010s, share price moves were good for both REITs and the broader indices of equity markets, be it the S&P or the FT or any index you want to take. But if you look at, say, a longer period, the 1990s, only in 4 years were the performance of REITs and the broader indices for equities within 10 percentage points of each other. So actually, we've had a very unusual period in the past decade when the two have been performing, both in sort of fairly bull markets. So at least the ratios do point to the REITs not being overvalued, but that underperformance that, we've been looking at is tempting. They've underperformed the market a lot in the past couple of years. But interest rates obviously affect REITs more than the broader market. And as I say, if you look at past periods, there's been quite significant divergence. In the 1990s, they only were going in the same direction broadly for 4 years out of 10. So I wouldn't say that you've got a significant guide by the fact that REITs have underperformed. There are very specific reasons why they've underperformed. And there are also good reasons why both equity and REITs broadly did well from 2010 until 2021, namely the REITs driven by falling interest rates and the broader market by rising earnings. So, I come back to the chart that we've looked at, which is that over the past year, REITs have gone up, they've gone down. That's still well below where they were a couple of years ago. But we should look at the REITs relative to NAVs. And on that, they do, on the face of it, look a little bit cheap, but really they're about in line, I'm afraid.
Yeah. All right, Mike, thank you so much for your time. I think we'll leave it there for today. I think it's been extremely valuable for investors. And yeah, thank you to our viewers as well. Please don't forget to like this video and join in the conversation by commenting and sharing your thoughts. We appreciate your time. Thanks.
Thanks very much, Larissa. Bye.